In this video, we are going to handle the inventory system as one of the transaction systems. But before we start, do not forget to subscribe, like, comment, and share with your friends. So we are going to start with the key activities, the common documents, and then the accounts that are used in the inventory system. So these are the key activities, the common documents, and then the accounts that are used in the inventory system. Inventory stock. Another name for inventory is stock. Yes, so the key activities, the first one is purchasing. They have to purchase stock. Then receiving, when you purchase something, you have to receive it. Then receiving, after receiving, they will have to record in the store books or prepare the store account. So recording, after recording, they will be taken to the store, which is storage. Then there is the delivery or requisition, like they deliver them to the intended users. In case those goods were needed by the production department, they deliver them to the production department. In case they were needed by the marketing department, they do the same. Then counting, like before storing, the goods are supposed to be counted. There is also counting to know the opening stock and then the closing stock, that counting. Then valuation, to know the value of inventory, because the value keeps on changing depending on time and other factors. Yes, so those are the key activities in the inventory system. Then the common documents that are used. Purchase requisition. This is like requesting for the purchase of particular stock. Like in case the production department needs maybe pins, they will have to request for the purchase of pins. So that is purchase requisition. Then purchase orders. These are sent to the supplier. It's like an order sent to the supplier so that they can be able to get you the goods that you want. Then the goods received notes. So this is prepared after receiving the goods. It's prepared by the company, and then the original copy of this is sent to the supplier, and then the entity remains with the duplicate. Then supplier invoices. These ones are from the supplier to the entity, and they show the amount that is supposed to be paid. Then the inventory master file, it records everything about inventory. Then the production schedule, it's like a timetable of production. The store or material requisition, this is like requesting materials from the store. Then cost accounting records, they record information about materials. Then the general ledger records everything. Then the accounts that are used, we have the inventory ledger account. All these accounts just record things about stock or inventory. Inventory ledger account, stock control account, the cost of goods sold account, the raw materials account, direct labor account, manufacturing overheads, work in progress, and finished goods. So those are the key activities, common documents, and then accounts that are used in the inventory system. So now let's look at the assertions, objectives. Let's look at the assertions, objectives, key controls, and then test of controls in the inventory system. Let's look at key controls in the inventory system. The first one, as usual, is occurrence. So for the inventory system, we have occurrence. Occurrence is making sure that something either exists or something took place. So for inventory system under occurrence, we have two objectives. The first one is to ensure that inventory movements are authorized and recorded. Like whenever they receive inventory, it is recorded. Whenever inventory goes out, maybe in terms of sales, it is recorded. Whenever inventory is given out to a particular department, it is recorded. So the first one is to ensure that inventory movements are recorded and authorized. Then the second one is to ensure that the inventory that is recorded in the statement of financial position, that is the closing inventory, the inventory included in the statement of financial position physically exists. Then the test of controls, as I told you, for the control for occurrency, before you think of anything else, the first control is segregation of duties. So the controls that can be put in place to achieve this objective, the first one we have is segregation of duties. So segregation of duties of maintenance of records and custody of assets, like you assign different people. You assign someone different to be in charge of maintenance of the inventory records and someone else to be in charge of custody of assets. Yeah. So as I told you, the first control for currency before you think of anything else is segregation of duties. So what's the test of control for this? The auditor is supposed to observe and see if there is proper segregation of duties, if the person who is in charge of maintenance of records is different from the person in charge of custody of assets. Yeah. Then another control that can be put in place. Another control that can be put in place is use of pre-numbered goods delivered notes, store requisitions, and goods received notes. Like you number the goods delivered notes that show that you've actually delivered those goods to the customers. Then the store requisitions, you also number them, and then the goods received notes. Yeah. Remember, we are dealing with inventory. In inventory, we have selling, because you sell inventory, and then you purchase inventory. So there is selling and then purchasing and all that. So here, what's the test of control for this? The auditor is supposed to select a sample of GDNs and then store requisitions, goods received notes, and see if they are properly, and see if they are pre-numbered. Yeah. Then another control is reconciliation of inventory ledgers with the stock ledger account. So you keep comparing the inventory ledgers and then the stock ledger account to see if they are matching or not. And if they are not matching, the difference is investigated. Then another one is a physical safeguards of inventory against thefting. Yeah, you put safeguards there that can help to protect inventory. For example, the CCTV cameras, the padlocks, and all that. So how can the auditor? So for this, the test of control for this is the auditor is supposed to review and then inspect to see if there was a proper reconciliation of inventory ledgers with stock ledger account, and then the auditor can also select a sample and then reconcile. And then the physical safeguards, here the auditor is supposed to observe and see if the physical safeguards, if the padlocks on the stores, if the CCTV cameras and all that. Yes, so that is the occurrency assertion. Then we go to the next assertion, which is completeness. So for the completeness assertion, the objective is to ensure that purchases, production, and sales of inventory are recorded. To ensure that whatever is sold is recorded, whatever is produced is recorded, and whatever is purchased is recorded. So that is the objective of the completeness assertion in the inventory system. Then what are the key controls that can be put in place? The first control is procedures are put in place to include consignment inventory held by third parties and then exclude consignment inventory held for third parties. Like consignment inventory. Okay, let's start with consignment inventory held by third parties, like when the inventory of the organization is being kept by maybe someone else. That's what we call consignment inventory held by third parties. Then consignment inventory held for third parties, like when the entity is keeping inventory that belongs to another organization. So that's what we are meaning here. So this control means that the entity is supposed to have procedures, yeah, of how they can record their inventory that is not in the premises of the organization, but it's held by someone else. Like the entity is supposed to come up with procedures on how they can record their inventory that is held by someone else, and then if they are keeping something that doesn't belong to them, then they are supposed to exclude it from their inventory. That is the that's the That's the control. Then the key control, the auditor will have to review the procedures regarding consignment inventory. Yeah. Then another control is reconciliation of accounting records with physical inventory. Like you reconcile, you match, like what was recorded in the books and then what is actually available to see if they are matching. Yes, so reconciliation of accounting records with physical inventory. Then how can the auditor test this kind of control? To review the reconciliation of recorded inventory with physical inventory, and then the auditor can select a sample from the inventory that was recorded in the books and then trace it to see if it's actually available. Yeah, so that is the completeness assertion. Then the next assertion we are going to look at is the accuracy assertion. So the next assertion is accuracy. Something accurate, it's something that is correct. So what are the objectives here? Is that to ensure that inventory is accurately recorded. As I told you, the objectives are the same, you just keep changing the name of the system. In purchases, we say to ensure purchases are accurately recorded. So it's just the same. Then here we have another objective, is to ensure that inventory is properly valued at the lower of cost and net realizable value. According to IAS 2, inventory is supposed to be recorded at the lower of cost and then net realizable value. So this assertion has the objective of ensuring that inventory is recorded at the lower of cost and then net realizable value. So how can these objectives be achieved? So we come up with controls. So a control that can be put in place is inventory managers review inventory regularly. Like they always check to identify the inventory that is moving slowly, then the inventory that is outdated, and then excess inventory. Yes, so this will help them to ensure that inventory is recorded, like inventory is accurately recorded. And then for this, in case they identify inventory that is outdated or that is getting outdated, it will help them to ensure that inventory is valued at the lower of cost and then net realizable value. So what's the test of control that can be put in place in case of this? Your auditor will discuss with management and see how they review inventory, and then the auditor can also attend the inventory count to see how such items are identified, the slow moving, the obsolete, and then the excess inventory to see how they are identified. So that's the test of control that can be put in place. So that is the controls are many, yeah, but I chose that one. So the next assertion is cutoff, and cutoff is to ensure that inventory is recorded in the correct accounting period. So there, the control that can be put in place is ensuring that the goods delivered notes, the goods received notes are recorded on a daily. The controls for cutoff are also somehow the same, you just keep changing the name of the documents. So to ensure that goods received notes and goods delivered notes are recorded on a daily. Then the test of control will depend on the way the control is stated. Then for classification, to ensure that inventory is recorded, classification to ensure that inventory is properly classified in its accounts. Then for the control and the test of control, they are all the same for each system. So that is all about the inventory system. In case of any questions, you can ask.